Good morning, friends. My name is Anup Nigam. I'm a technical analyst. In the last video, we learned about how do we calculate the payoff for the long call option strategy. Now, in this video, we'll try to understand how do we calculate the payoff for the short call option strategy. Short call is essentially traded by aggressive investors who are very bearish about the prospects for a stock or index. Selling calls can offer limited profit potential and the possibility of large losses on big advances in underlying asset. So when we sell a call, it means we are bearish on the stock or index and we expect the underlying stock or index to fall in the future. Now, when to use this strategy? This strategy is only to be used if we are bearish on the stock or index. The risk is unlimited, whereas the reward is limited to the amount of option premium. The break even can be calculated by adding the strike price and the premium. Now consider that we sell the call option of a stock X of a strike price 2250. So whenever we sell the call option, we are likely to buy it back at a future date at an unknown price. So when we sell the call option, it refers to as short call. Now in this scenario, if the spot price goes above the strike price, the seller will make the loss. If the spot price remains below the strike price, the seller will make the profit. Now consider that the spot price of stock X trades at 2694 and we sell a call option of strike price 2600 of stock X at a premium of 154. Now, if the spot price of stock X goes above 2754, the seller will start making loss. But if the spot price of stock X stays at or falls below 2600, the seller will make the profit. Now, in this situation, the buyer will not exercise its option and the buyer will let it expire worthless. So the maximum profit to the seller in this situation is of the option premium. Now, let us try to understand this with the help of this table. So the strategy name is sell call option, or we can also call it short call option. So if the spot price of stock X trades at 2694 and we sell the call option of strike price 2600 at a premium of 154, so break even would be strike price plus premium. That means it would be 2754. Now we'll try to understand how do we calculate the payoff for the short call. So now we know that we have sold the call option of strike price 2600 at a premium of 154. So if on the expiry the spot price of stock X closes at 2400, the seller will make a profit of 154. If it closes at 2500, the seller will make the profit of 154. If it closes at 2600, we will make the profit of 154. If it closes at 2700, we'll make a profit of 54. And if it closes at 2754, which is the break even point, so we'll make no profit, no loss. Now, the moment the market starts going above this particular point, the seller will start making loss. So if it closes at 2800, the seller will make the loss of 46 rupees. If it closes at 2900, the seller will make the loss of 146. And if it closes at 3000, the seller will make the loss of 246. So from this table, we can evaluate that the reward in this strategy is the option premium, and that is limited. Whereas if the market goes above the break-even point of the seller, then he'll have unlimited loss. Now let us try to understand this with the help of the graph. So if we sell the call option of a strike price 2600 and if the spot price remains below to this strike price and goes lower and lower and lower, so the seller will have the profit of option premium. Whereas if this spot price starts going above the strike price, the seller will have unlimited loss. So guys, in this video, we have tried to understand how do we calculate the payoff for the short call position. So if you think that this video is informative, then please like this video, subscribe my channel and share this video with as many people as you can. Thank you. Dhanyavad.